Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing fuboTV stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. FUBO is a streaming television service with customers in the US, Canada, and Spain. The company's main focus is on live sports. It offers all the major sports: NFL, MLB, NHL, NBA, soccer, as well as many others. You can also watch the news, regular TV shows, and movies. The cost is pretty high, $70 or $80 per month, which is much more than Netflix and Hulu. It launched in 2015 as a soccer streaming service. Then in 2017, it added more options. At the end of 2021, it had 1.1 million subscribers, and it expects to hit $1 billion of revenue this year. The company is headquartered in New York, and was founded in 2015. The ticker trades on the New York Stock Exchange and Mexican Bolsa. Let's get started with the model. This is a small cap company, 951 million market cap. They're trading at $6.17 a share, and they have 154 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Since they're such a young company and growing their revenue, they still have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, and they added subscriptions in 2020, so they didn't really have much revenue before then. But you can see it's growing a ton. It's over 600 million in 2021, almost triple 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example of cost of revenue is the cost of labor. Revenue minus cost of revenue gives you your gross profit, and that is negative each year. Below that is their operating expenses. Marketing is their biggest operating expense. Gross profit minus operating expenses gives you your operating income, which is negative every year. Below that is the interest they pay in their debt, which was 28 million in 2021. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. If it's a big negative, it's likely an asset impairment. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which is also negative every year. This is the company's income statement from their 10K. Their subscription revenue started in 2020, and that grew a lot from 184 million to 564 million. They also charge for advertising space on their platform. That went from 25 million to 74 million. And the more subscribers they have, the more they're going to be able to charge for advertising. They didn't receive anything from licensing in 2021, so their total revenue was 638 million. Almost all their revenue is in the US. A very small amount is international. Their subscriber-related expenses were 593 million. An example of this is customer support. Broadcasting fees was 56 million, marketing 142 million, technology and development 61 million, general and administrative 108 million, and depreciation and amortization 38 million. Last year they passed through a large impairment. That's why their operating loss was a lot more in 2020 than 2021. I wouldn't be concerned they have operating losses right now, because they're in growth mode. They're sacrificing profit for greater growth in the future. So they're reinvesting back into their business through marketing and also through building their technology. They're also trying to add more channels to their service. The interest they paid on their debt went down from 18 million to 13 million. In Yahoo Finance, it looked like they paid more interest on their debt in 2021. But more than half of that was amortization of debt discount. Amortization of debt discount are the expenses a company incurs when they sell bonds, because there's various expenses, registration fees, legal fees, etc. They don't pass through the entire expense when they issue the bond. They amortize it over the bond's life. And amortization is a non-cash item, so we add it back on the statement of cash flows. And the only reason their net loss is worse in 2020 was this large impairment. Their net loss in 2021 is $383 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spent the most in CapEx in 2021, over $13 million. This is mostly investments in their software. Operating cash flow minus CapEx gives you your free cash flow. And they had their worst year in 2021 at negative $206 million. But as they scale and grow, and once they hit a certain amount of subscribers, they'll eventually become break even. And then profits will come in a lot faster and their margins will grow a lot faster once they pass that break even point. They're funding their business on debt and equity. They added $280 million of equity in 2020, $140 million in 2021. They also added a lot of debt in 2021, $389 million. They paid down $25 million. This is the company's operating cash flows. And operating cash flow converts net income into cash. Even though their net income was worse in 2020, they generated more cash flow in 2020. The negative is smaller than in 2021 because we have to add back those impairments, $100 million of intangibles, $148 million of goodwill. An asset impairment brings down your net income, but it doesn't affect cash. So in 2021, even though they reported a loss of $380 million, they actually lost $192 million of cash flow. It looks like their revenue is forecasted to grow to $2 billion by the end of 2024. Even with such strong revenue growth, their operating cash flow is still projected to be negative. In my model, I have negative free cash flow until the end of 2024. Then it's positive for the first time in 2025. This is their investing cash flow section from the statement of cash flows. There were some pre-merger inflows and outflows. A cash outflow of $619 million from the sale of FaceBank. FaceBank is FUBO's parent company. They acquired FUBO. FaceBank was trading over the counter, but once they acquired FUBO, they uplisted to the New York Stock Exchange. It looks like in 2021 they spent $23 million of acquisitions. They spent $5 million on property and equipment. They spent $40 million to access content. That's the big expense for Netflix, spending all that money on content. They need to pay the owner of the content the right to put it onto their platform. I imagine as this company grows, those fees will start to increase. In their investing section, they had a cash outflow of $76 million. Back in 2020, Disney bought a big chunk of FaceBank. I wonder if they still own a lot of FaceBank. If they do, that means they own a lot of this company. This is their financing section from their statement of cash flows. And they issue lots of warrants, $280 million in 2020, $140 million in 2021. You could think of warrants as long-dated options. They're also sometimes used as sweeteners for bond issues. And in 2021, they issued nearly $400 million of convertible debt. If their stock price goes up a lot, then this debt will convert to equity, which will dilute your shares. Because when debt is converted to equity, that increases the shares outstanding, which means everybody else has a smaller piece of the pie. In their financing section, they had a cash inflow of $500 million. Last year was a cash inflow of $280 million. This is the equity section on their 12/31 balance sheet. They have $670 million of equity. They raised $1.7 billion from selling their business, and they lost $1 billion from running their business. Non-controlling interest is if an investor owns a chunk of the company, usually between 10% and 50%. This may be Disney's ownership. I was going to email the company because usually I see non-controlling interest carved out of the equity section and just sitting below it. They put it inside the equity section. This could affect some of their ratios, like debt to equity ratio, ROE, and price to book. But it's a pretty minimal amount, so it's not too much of an effect. Let's look at the capital structure. $671 million of equity, $360 million of debt. They're 65% equity, 35% debt. And they could pay off all the debt with the cash on their balance sheet and still have $10 million of cash left over. This blue line is their equity balance, and it has grown a lot in 2020. And since 2020, it's been pretty flat. Their cash and debt balance have been growing at a similar rate. I gave them the highest whack on Finbox, 10%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.6 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.4 billion. We divide that by 154 million shares. And we get a calculated stock price of $9.16. They're trading at $6.17, so they're trading at a 33% discount. It's a buy according to the model. The company said they project their revenue to be almost $1.1 billion in 2022, which is a 70% growth from 2021. So my model does assume they'll hit that revenue target, and I gave them more of a modest growth after that, 20% a year for the next 3 years. That's how I got their future revenue estimates. The average company in their industry converts 10% of their revenue into free cash flow. So I assumed they would convert 10% of their 2025 revenue into free cash flow. And then I assumed they would have negative free cash flow in 22, 23, and 24. If they hit these targets, the stock is worth $9.16. Of course, they can crush these targets and the stock will be worth $40, $50. But no one can predict the future. I'm just trying to use available information to identify whether the stock is over or undervalued. That's pretty much what I do every video. In the short term, the stock doesn't move on fundamentals. In the long term, it does. In the short term, stocks move on momentum and investor sentiment. And the latter of that equation I still haven't figured out. The website Simply Wall Street values the company at $1.80. They're saying it's extremely overvalued. 8 analysts priced this stock and the low is 9, the high is 20. The average price target is $15. This is where the stock has been trading since FaceBank acquired FUBO. Lots of stocks trade really high initially and then there's a big crash. Maybe we should start shorting stocks after they're trading for a few months, because it seems like they almost always come down. But the hard part is figuring out when to short them. Should we have shorted them at 25? Obviously not, but we might have. Should we have shorted them at 35? If you could have shorted them at 45, you could have made a ton of money. Say we were waiting for the right time to short the stock and it hit 45. And then we said, let's wait another week or two. Let's see if it hits 60. Then if it came down to 35 in the next week or two, we probably would not short it because it was just 45. We'd probably wait for it to go back up to 45, and it never would. If you invest in this stock and the S&P 500 in April 2019, you would have been up over 300% with this stock. But if you're still holding on, you'd be down 38%, while the S&P is up 47%. They grew their subscribers 93,000 from the third quarter of 2020 to the fourth quarter of 2020. In 2021, they doubled that, growing at 185,000. Now they have over 1.1 million. By the end of this year, their forecast is to have 1.5 million subs. Subscribers are important, but equally as important is how much money each subscriber spends. And the average spend rate is going up from 59 to 69 to 75. People must love this service because they spend a lot of money. They have a crazy high beta, 3.39, so the stock is more than 3 times as volatile as the market. It's gone down 80% in the past 52 weeks, while the S&P is up 6%. The 52-week low is 6, the high is 35. And the stock is trading below its 50-day and 200-day moving average. Over 10 million people each day are trying to catch the falling knife. Of the 154 million shares outstanding, 145 million are on float, 37% are held by institutions, and has a high short percentage. Over 23% of the shares are shorted. This company is doing a good deed in employing lots of people each year. Their employee count has grown a ton, up to 530. If you invested $10,000 when this stock was uplisted, you would have been close to $50,000 after a year. But if you're still holding on, you'd be at under $7,000. That's a 34% loss. One insider bought 3,000 shares at $8. Someone sold 455,000 shares at a pretty high point, $36 per share. Half the shares are held by the general public, 44% by institutions, 5% by insiders, and under 1% from private companies. The biggest shareholder is Vanguard at 7.5%, then BlackRock, North Zone Ventures, Marshall Wace, and last is Luminary Capital. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They do have a good price to sales of 1.5, that's stock price over sales per share, or its market cap over revenue. This means investors are paying $1.50 for $1 revenue, which is better than the market median and the market average. And they also have a good price to book of 1.4, that's stock price over book value per share. They do have negative tangible book value, since they have a good amount of intangible assets on their balance sheet. Let's look at their non-current assets. 6.8 million of property and equipment, 5 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. Here's a list of their intangible assets. Software and technology, 180 million. Customer relationships, 24 million. And trade names, 38 million. Intangible assets are amortized. Tangible assets are depreciated. Although not all intangible assets are amortized, goodwill is tested annually for impairment. Before 2004, they used to amortize goodwill, but FASB changed that rule. They have 630 million of goodwill. Goodwill is the premium you pay when you acquire another company. 38 million of right-of-use assets. These are assets the company does not own, but they lease it from another company. Even though they do not own the asset, for accounting purposes, it does appear that they own it because it's reported as an asset on their balance sheet. It's also reported as a liability because they owe the lease payments. And 43 million of other. Let's look at their non-current assets. 316 million of convertible notes. If their stock price goes up and these notes convert to equity, then they remove the debt off their balance sheet. That's a big benefit for the company when their stock price goes up. Their convertible debt converts and they strengthen their balance sheet. But besides that, there's not that much benefit for the stock price going up for the company. The benefit is for the people trading the stock in the secondary market. 2.4 million of deferred income taxes. This should increase their tax bill in the future. They owe 34 million of lease payments on that right-of-use asset we looked at earlier, and 9 million of other. And they have a good current ratio and quick ratio, both above 1. Current ratio is current assets over current liabilities. Let's look at their current assets. 370 million of cash, 34 million of receivables. This is how much money is owed to them, and 19 million of prepaid and other current assets. Prepaid assets is when a company prepays for a product or service they're going to receive in the future. Let's look at their current liabilities. 56 million of accounts payable. This is how much money they owe others. 220 million of accrued expenses. These are expenses the company has incurred but has not paid it yet. 5 million in notes payable. 44 million of deferred revenue. Say the customer buys a subscription for 1 year up front. Let's pretend they paid $600 for the year, so that's $50 a month. They put that $600 in deferred revenue, and every month they pull $50 off their balance sheet and book it onto the income statement as revenue. They have a small amount of warrant liabilities, debt, and lease liabilities. They lost 200 million of free cash flow in 2021, and they have 91 million of working capital. So it looks like they're going to be short this year, so they may need to add some more debt or equity to fund their operations. The best way to look at ratios is to compare them to companies in the same industry. There are 25 companies in the same industry as FUBO, and they're ranked 13th in market cap at a little under 1 billion. The average is 4 billion. The only ratio better than average is debt to equity ratio. Their price to book is a little worse than average. We can't look at their PE or price to free cash flow, and their price to sales is a bit worse than average. To summarize, I have them trading at a 33% discount, and this company is really specialized. They're really focused on live sports. That specialization is going to give them the ability to compete with Disney and Netflix, because they cannot do what Netflix and Disney does. They'll never be able to compete at that level. But if Netflix or Disney wants to start streaming live sports, then that could crush this company. So I'm not too sure for a long-term play, but it could be a good swing trade. I rank their free cash flow as 1 out of 10, their revenue 7 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.